All right, everybody, welcome to our tax planning workshop today. Welcome, welcome, welcome. We're grateful that everybody could come and be with us and be part of this. We like having the technology that allows us to do this. And anyway, we're just grateful that everybody's on with us. We're going to be jumping in and just going through everything with regards to tax laws and what we're seeing, and maybe some strategies that can help you. At the end of this, the original intent that I had with this was just to go through tax planning, but with the markets being what they are right now, I also have some slides that I've prepared at the end for maybe an economic overview real quick. If you have time to stay with us, that's great. If you don't have time to stay with us for that, feel free to leave and just jump off. So either way, we'll help you the best that we can. As we go through this, just a reminder, as we always do, there are 5 key areas of financial planning that we work with, and all of them are important. And today we're going to be focusing on tax planning. We'll focus a little bit on the back end, on the economy and investment planning. But all 5 of these are important. And as we do these workshops, we'll be focusing on different ones at different times, trying to give a little bit of update in things that are happening and how we might be able to best help you. So as we go forward, hopefully I can make all of this work the way that it should. But, one of the key aspects that we look at as we're doing planning with clients is that investments and your investment portfolios are really only half of the equation. And if we can help add some additional value through some tax planning and helping you to avoid some taxes and be able to take the taxes that you do have to take in a effective manner, and rather than just allowing the taxes to be what they are, a lot of times we find that we can add a lot of value to our clients' portfolios with this additional focus that we have. As we look at 2021 for taxes, there are a few things that you can still do before you file. We're going to be looking at 2022 taxes as well as we go forward. So things that you can be aware of as you're looking to keep records for your 2022 taxes, and also just strategies that you can have to make sure that that's working for you. Now, you're probably aware, and I'm just going to point some of these things out. Currently, we have these 7 tax brackets that the taxes are bunched into. And one of the things that happens is that we have here $81,000 that keeps us in the 12% marginal tax bracket. And one of our hopes is that as you get into retirement, there are some times that potentially we can push you back down into that 12% marginal tax bracket and hopefully take advantage of some additional tax savings opportunities that might be available to you. We'll talk about that a little bit more, but you can see here that 12% tax bracket goes up to about $81,000. If you add your standard deduction on top of that of about $25,000, you're up at about $106,000 that you can have as taxable income and still stay in that 12% marginal tax bracket. With the 5% for state, it puts you at a 17% overall tax bracket. And for as much as we can, we like to keep as much of your income in that 12% tax bracket as we can. 22% goes up to 172. Again, adding 25 on top of that, it puts you roughly at $200,000, a little bit under. And then once you get into the 24% tax bracket, there's a whole bunch of additional things that come into play. The net investment income tax, and there's some other taxes that additional 2% and 3% taxes that come into play after that. And if we can keep you below this tax bracket, there's quite a bit of savings that we can help you take advantage of. All right, so one of the things that is a little bit of, I don't know, it's a little bit of a gotcha for the tax laws that were passed by the Trump era, and that is the SALT deductions. The SALT deductions basically cap your state and local income tax deduction at $10,000 for those that have property or real property or have property tax or a higher state tax. a lot of times you're not getting deductions on this that you otherwise might have had in prior tax brackets. But our feeling on this is that because the tax brackets are so low right now, it's probably still more advantageous to have the lower tax bracket than it is to have this deduction. So we don't know whether this will come back or whether it won't come back. Previously, last year, we did a webinar that was talking about potential that the Biden administration was going to change the tax laws. There was actually quite a bit of support for changing the tax laws. That did not happen, and it seems like now there's so much on the plate that it's, to us, it feels like that it's unlikely that that's going to go through or continue to move forward in any type of form. So with the current tax laws the way that they are, we know that these will sunset in 2025, and it will go back to the tax rate that were pre-Trump era tax rates. And so the tax rates will go up automatically in 2026, just because this particular tax law that was passed is going to sunset and will no longer have those. So we have still a couple of more years that we can implement some tax strategies and possibly taking out, maybe pulling out a little bit more now in some of your income than we might later, potentially can be a good strategy. One of the things that we look at very particularly in this is not just the amount of taxes that you're paying. It used to be when we looked before with the old tax laws were basically you defer any type of gain or income that you can, and that you accelerate any deduction that you can. And that was primarily the thought process with the prior tax law. With what's happening now with the current tax law, it's not so much about acceleration and deferring, it is more about timing. And if we can time your taxes and when you take those taxes out and the amount of taxes that you take, the long-term effect of that is can basically save you quite a bit of taxes down the road. And so that's one of our goals as we're working with our clients is helping you time those tax brackets rather than just taking it as they come. Long-term capital gains rate is something that we really look at hard right now under current tax law. Again, up to about $100,000. If you look here at this $80,000, you add your standard deduction on top of that, you're basically looking at $100,000 that you can take in capital gains that is completely tax-free to you. Now, this is on top of your regular income. So, but for an example, if we could come in and we could help you shut down your income in retirement, give you a couple of years to recognize your capital gains, take your basis up higher so that your basis as you start recognizing gains in the future is a lot higher, and we've taken those at a 0% tax bracket. There's definitely a lot of things here from capital gains rates and those type of things that should be considered. And it's just one of the big things that we look at going forward as far as the timing of the taxes and how you should be looking at this going forward. Okay, for those that itemize, for your cash contributions to qualified charities, it used to be a limit on how much you could contribute. It's now up to 100% in 2021 of your AGI. So, and that will be true for 2022 as well. So if you have charitable intent, there's definitely some opportunities there that you otherwise wouldn't have just because of the new tax laws and what's happened with those. Okay, now charitable contributions, this is kind of a gimme. I want every one of you to make sure that you're taking this on your tax return. If you look here on your tax return on this standard deduction, there is a $300 tax deduction for a charitable credit. If you're donating clothes to Goodwill or to any other type of charity, or you're donating to the Boy Scouts, or you're donating to whatever you want to donate, you don't have to itemize. There's an automatic $300 charitable contribution deduction that you can take without any itemization whatsoever. And with a joint tax return, it's $600. So make sure that all of you are taking advantage of that. You don't have to have a whole lot of documentation to take that. It almost feels like a gimme that you need to be making sure that you're taking advantage of. In retirement plans, one of the things that we'll talk about here for just a minute is that with your traditional and Roth contributions, you can go up to $7,000 if you're over age 50. If you're under age 50, you can do $6,000. That will go up. We'll talk about that a little bit later for 2022. Traditional 401ks, 26,000, SEP IRAs, 58, individual solo Ks, $64,000. If you have a business and you need some tax deductions, these qualified plans really are one of the last tax deductions that we have available to us. And the thought process is, again, from a timing standpoint, if you're in a higher marginal tax bracket right now, and we can get a tax deductions off from those on a significant basis, and then wait until another time in your life where that we can force income lower, maybe through retirement, deferring Social Security, deferring taking out of your 401k plan so that you don't have as much income and you can stay in that 12% or maybe the 22% marginal tax bracket. We then can convert these qualified plans over to Roth IRAs. You'd never be taxed on those again. And we'll talk about that a little bit later as well, and maybe delve into that a bit deeper. One of the things that we look at on an ongoing basis is that if you've got dividends in your portfolios, now, depending upon what type of portfolio you have, if you've got a portfolio that's primarily made up of mutual funds, there's not a lot that you can do about dividends. The thing that you have to make sure of is that if you have like a brokerage account and you've got individual stocks in there, and those dividends are being reinvested in those accounts, you need to make sure that the basis is being increased based upon those reinvested dividends, because you're not getting the cash, because the cash is purchasing additional shares or additional value in the individual stocks. And unless it's being recorded, you will have to pay taxes on those dividends twice. So make sure that as those dividends come out, you're already going to get a 1099 on those for a taxable event. Make sure that your basis is being increased on that so that you don't have to be taxed twice on that. Any carryover items from prior years, make sure that one of the things that we notice from time to time is that if you switch accountants or your accountant maybe isn't keeping good records, or any number of things can happen. There are carryover losses a lot of times that we see that our clients have on their tax returns, and then somehow they get missed on the next year. And so those carryover losses, you're not, once you miss those, you're not able to take those as a deduction, and it can cost you quite a bit in long-term tax savings. So make sure that any carryover items, make sure that you're double checking that when your CPA prepares your tax return, and make sure that those carryover items are being included. Also, qualified distributions. One of the things that can happen is once you turn age 71, if you have charitable intent of any kind whatsoever, it is better for you to do a QCD, it's called a qualified charitable distribution, out of your IRA rather than taking it out of your regular income. The reason being is because number one, if you are not itemizing, if you're not itemizing deductions, and you say that you pull money out of your IRA, you then take that cash that you've pulled out of your IRA and then you pay your charitable donations, there's no deduction for it because you don't have enough deductions to get above the standard deduction. Whereas if you do a QCD, what happens is that when they give you the 1099, that amount that you've pulled out of your IRA is not included in your taxable income. And so it reduces your taxable income rather than taking it off from an itemized deduction, which still allows you to get the full standard deduction, but it also allows you to completely get the contributions that you're making to your charitable contributions, it's making those so that you don't have to include those in income. So you kind of get the best of both worlds if you start doing those QCDs. So that's something that's really important that we look at as well. All right, so 2022, what are we looking at going forward? Number one, you can see here that the tax brackets will be pretty much the same as they are this year as far as married filers, and head of household. It really doesn't change much, and these won't change until 2026. So once the tax laws sunset, standard deduction is still the 25.1 for head of household, 18, and for single filers 12.5. So not much has changed as far as the tax bracket's concerned. We've got a couple of more years with regards to that. Also, capital gains rates are staying about the same. Not much new. It's just timing of those assets and making sure that you're taking advantage of these lower rates right now. If we look at your contributions for 2022, though, you can see that contributions have gone up. Elective deferrals for 401ks go up from 19.5 to 25, or 20,500. So you can see there that we've got another $1,000. Catch-up contributions to 401ks are another $6,500. So between the two of those, you can now, if you're over 50, you can put $27,000 into your 401ks. It's a nice tax deduction. And again, if you can plan this in a manner to where you can take that out at a lower tax bracket down the road, either through shutting off your income or some of the other strategies that are available, it makes a lot of sense to be taking advantage of these right now. Again, if you're a small business, there are other types of plans that are available, simple plans, defined contribution plans. One of the things that we look at is that if your cash flow is sufficient in your businesses and you have a business, you can do both the 401k and a profit sharing on top of that. And between those two, you can take it up to the $61,000 of tax deferred income rather than just the $27,000. So there's a lot of additional runway if you have a business and can set these up above and beyond just the traditional 401k. All right. If we look at exclusion gifts, now this is gifting to children, grandchildren, whoever you're gifting to. We've seen a little bit of this happening. You can gift up to $16,000 per year now with 2022 maximum. If you want to do 529 plans, those are plans that are set up to where you can set up it's not a qualified account, but it's an account that does save a little bit of taxes for your kids. You can set up some college education funding for them through 529s. We've also done quite a bit of college education planning with Roth accounts. And we'll talk about maybe a little bit about the difference between those two types of plans here, maybe in another presentation. Tax projection. One of the things that we want you to make sure that you're always doing is to do a tax projection for the next year. Because what happens is that if you do a tax projection, all of a sudden you see, oh man, there's some additional things that are coming here. What can we do before year end to be able to potentially mitigate or lessen the impact of the taxes of these things? Or perhaps you have a lower tax year. Perhaps you're not making as much money for a particular year. Something's happened and maybe you're not making quite as much money and you want to accelerate additional capital gains into the current year. Doing a current year tax projection every single year is very, very important for everybody. Now, we do these automatically for those clients that we have on our financial planning side. For those that are not on our financial planning side, Brett can do these. There is a little bit of fee for it on his side. There's not on our side, but that's something that everybody should be doing just to see if we can do some advanced tax projections and tax planning for you to make sure you're being effective with your tax brackets. All right. Again, the whole thought process here is that as you're looking at your taxes, be proactive as you look through them. Don't just wait until you're in and say, here it is, and bring your stuff to your CPA and say, this is what happened. Take a little bit of more of a proactive approach and look at things beforehand and look at things that you can do to potentially not just impact your tax bracket this year, but to impact your tax bracket maybe 5 years from now or maybe 10 years from now. A good example of that is your Roth conversion strategies, right? If you do a Roth conversion strategy right now, you're going to have to pay taxes on it today, but in the future, there's a number of things that could help you with. Number one, required minimum distributions. It would reduce the amount of required minimum distributions that you'd be taking out. And if you take a lot of times, we have clients with these RMDs that the government is forcing out of the 401ks and the IRAs because you reach stage 72. A lot of times what will happen is that those between RMDs and Social Securities, it pushes you up into the higher 22% marginal tax bracket anyway. And there's not a lot of tax planning that we can do because everything's automatic and it's all set in stone. Where that if we can be a little bit more proactive on things, perhaps we can help manage some of those future tax brackets and give us a little bit more wiggle room down the road as well. So those are really critical planning points that we want you to be aware of. Roth IRA conversion benefits. Now let's just talk about that for just a minute. Yes, you're going to pay taxes on those amounts that you convert over to Roths. But again, as we talked about in the past, there's a couple of things here that happen. Number one, you won't have to pay taxes on that again. Based upon current tax laws, we have to throw that caveat in. And so if you've got large requirement or large amounts in your IRAs that are going to require large minimum distributions coming out of those IRAs, a lot of times these Roth conversions just make a lot of sense. And on our software that we've got with our financial planning, we can throw it together. We can take a look and see whether or not it really makes sense or not. We look at the numbers to make a non-emotional decision on it and make sure that it works for you and make sure that it's something that is beneficial for you. The other thing that it does though, and I want to kind of bring this up, is that if we were to look at what we call multi-generational tax planning or family tax planning, one of the things that happens is that Roth IRA assets are a lot easier to give to your children than traditional IRA assets. And the reason being is because traditional IRA assets, if you have significant IRA assets that have accumulated over the years, once you pass away, those IRA assets have to be distributed to your children within 10 years. And they will have to pay taxes on those amounts and add that on top of their already potential higher tax brackets. And so as you look at your children's tax brackets, if they're in higher tax brackets than you are right now, and you want to be a really kind person, you may want to go ahead and take the taxes in your tax bracket so that they don't have to. And so it's an individual decision. It depends upon how you feel about that whole situation, but Roth IRA assets definitely transfer easier to your kids because they don't have to pay taxes on them. They still have to pull them out over the 10-year window, but they can wait for a whole 10 years, let it grow for those 10 years after you pass away, and then pull that out completely tax-free with no income tax consequences to them whatsoever. So anyway, some interesting planning techniques as we look at from a family tax bracket management rather than just an individual or personal tax bracket management. So as we look at this, the other thing that we look at, and there's another slide here that we'll get into that family tax bracket management a little bit more, but let me just kind of go back for just a minute. So one of the things that happens is that if you're close on your itemized deductions, right now it's 25 plus change that you can have for standard deductions. Let's say with your property tax and your state and local tax and your contributions that you have and other miscellaneous deductions, let's say that you're just at maybe $25,000 or $24,000 or maybe $20,000 if you were to itemize. One of the things that you can do is that if you want to bundle your charitable contributions and pay 2 or 3 or 4 years contributions at once, you can do that either directly to the charity or you can do it through what's called a donor advised fund. And what the donor advised fund allows you to do is it allows you to donate that amount directly to the donor advised fund, but then you can tell the donor advised fund when and how and to whom you want that distribution given. You get the deduction up front. Your the charities that you can contribute to, you can actually delay when they receive those contributions. And the reason being is because the donor advised fund is set up in and of itself as a charity. And so by contributing to this donor advised fund, you get an immediate charitable deduction, regardless of when you actually give money to charitable organizations. Another thought process on this is that if you have property or if you have a business that you're selling and you want to take a portion of that and give to charity of some kind, it is better, substantially better. It'll save you about 20% on the amounts that you do this with in taxes. If you gift a portion of that asset that you otherwise would give to charity and gift a portion of that to the donor advised fund. And the reason that that happens is because, again, if you gift it to the donor advised funds, you don't have to claim it as income, number one, but you still get the tax deduction. So it almost doubles your tax deduction going forward. So it's a really cool strategy that you can use. The other cool thing about it is that if you have, let's say that you have children that you want to involve in some sort of charitable activity down the road, and you say, you know what, I'd like to take my children down to Peru and do maybe a humanitarian event down to Peru of some kind, but you want to save up for it for a few years, but you want it tax deductible. All you have to do is set up a donor advised fund. You put the money into the donor advised fund, you let it accumulate for a couple of years, you get a tax deduction off from it. Perhaps you're bundling your overall tax projections. And then in 5 years, you gift this money to the humanitarian program down in Peru or something, and you take your kids down and do a humanitarian type of thing. So there's a lot of fun things that you can do with these donor advised funds that make them quite a useful tool if you're looking to, if you do have charitable intent. All right, let's keep going. So again, coming back to the family tax bracket management, you can see here that for an individual holder of an IRA, this is when you don't want to convert to an IRA. If your tax bracket right now is high and your marginal tax bracket of your beneficiary is low, you probably, from a family tax bracket management, probably would not want to do the Roth conversion. You'd probably want to keep that in your bracket here, even though your RMDs are coming out at the higher tax bracket, and then coming here. And if the marginal tax of the IRA holder is lower right now and the marginal tax bracket of your beneficiary is higher, that's probably when you would want to consider possibly a family tax bracket management Roth conversion. All right, let's keep going. QCDs we've talked about a little bit. They allow at 70.5. They changed the required minimum distributions to age 72, but they left this in place at age 70.5. So if you do have charitable intent, this is a good way to get a little bit of a tax benefit and a tax bang for your buck with this. All right, so as far as the tax side of things, this is everything that I've got for you today. I'm going to transition over here to some economic review. If you'll just forgive me for just a minute, I have to change screens, but bear with me for just a minute. All right, so we'll jump in here for just a minute, and we're just going to kind of talk, as we've seen what's happened with the markets the first quarter of this year, especially with the war in Ukraine and with what's going on there with Russia. One of the things that we've noticed here is that it's interesting to us that the markets haven't fallen further than they have fallen. Right now, the markets are down about 10%. With the S&P 500, there are other indexes that are down more, but the S&P is down about 10% right now. And if you'll notice here, as of January 1, we had, now what this is S&P valuations. And just from an explanation standpoint is that for earnings for all of the S&P 500 companies, this basically tells us how much we're paying for the earnings that are being driven by the S&P 500. And it's basically called a multiple. And the 25-year average multiple for the S&P 500 is 16.85. In March of 2022, we were at 18.8, so almost 19 times. What that basically says is that at the average, based upon the earnings per share or how much corporate profits that an individual corporation has, if all you receive back was the earnings or that return of earnings that you're getting from the corporation by being an owner of that stock, it would take you roughly 17 years to recoup your investment. That's basically what this amounts to. These two lines here are the normal range. Anything outside of this range, either high or below, is outside of the normal trading range for the normal, they call it earnings per share. You can see here that as of March 1st, we were at 18.8. We are now, at March 1st, we're at 18. Before up here, we were up around 22, 23 times. So we were a little bit elevated with the markets. With the markets being as elevated as they were above the normal trading range, and with the crisis that we've had with Ukraine, I'm actually surprised that we haven't had more of a downturn in the stock market. So that's good news. And I want to show you why that's happened. Number one, corporations are, this is the earnings per share of the S&P 500s. This is as of 2021. You can see here that earnings per share was about $210 per share. You can see that in 2020, it was about $123 per share. So you can see that dramatic jump in 2021 as far as earnings per share. This is the economy recovering from COVID and allowing the economy to open back up. We were already on a pretty good projection before COVID hit. That kind of delayed things a little bit, but with technology and with other things that are happening, you can see that the economy is improving quite nicely. 2022, it's still projected to be up to 225, and 2023 is projected to be almost at 250. So again, we're seeing quite a bit of very healthy corporations right now with regards to their profits, with regards to their earnings per share, and this has continued even despite what's going on in Russia. All right, so let's talk about this for a little while, because this is a new slide that we haven't addressed here for a little while. But what you're seeing here is that the reality is that there are two different types of stocks. One's called growth, one's called value. The primary difference between the two, and it's a little bit of a fuzzy line between the two, but the difference between them is basically how much dividends they pay out. If a company is more mature in their life cycle and they don't have as much appreciation upside, they typically have to pay higher dividends to entice investors to want to come and invest in their companies, to give them working capital to be able to make things work. For companies that have a pretty good growth record and appreciation on their stock, they don't have to pay out nearly as much dividends, but typically you pay a higher price for those growth stocks than you do for the value stocks. And so there's a give and take. If we look over the last 50 years, value has outperformed growth, but there are times where the growth has been quite a bit more. For the last 10 years, as a matter of fact, growth has been where to be. In fact, the top 10, we'll show another slide here that talks about the S&P and some of the growth of the S&P. But the reality is over the last 10 years, if you haven't been in the S&P, you have not been earning as much investment as you maybe would have if you would have just gone solely with the S&P. But what we're seeing here is that tide may change here, because now we're seeing that growth has become quite expensive, and we are seeing a turn now in the value side of investing. In our portfolios, we have a very healthy mix of value in the portfolio. There was a period of time that hurt our portfolios for a little while, but long term, we feel like that's going to dramatically increase and benefit long term the portfolios going forward. So anyway, just a sidebar there with growth versus value. Now, here's the concentration, and let me just show you what this is. This is the top 10 stocks in the S&P 500. And you can see here the value or the earnings per share or the multiple again from that first slide that we're talking about on the top 10 stocks. So this is the amount that we're paying for those top 10 stocks. This is the amount that we're paying for all of the rest of the market. And so this includes value. This is primarily growth. And what we can see is that, number one, growth is quite a bit overvalued. The average for growth is about 19 times. We're currently at 28 for those top 10 stocks. The remaining of those stocks is about 17. The S&P is at 18. So having a good dose of value in your portfolios, we feel like is going to be a great benefit to people going forward. And you can see here in this slide, ever since 2016, you can see how those top 10 stocks have dramatically become a dominant force in the S&P 500. And you can see that right now, as of March 1st, if you took the top 10 stocks, it's 30% of the value of the total S&P 500. So again, a very significant overweight. We just feel like we need more diversification in the portfolios. This is a slide we've shown often. It basically shows that in every single year we've had a pullback. The average pullback intra-year or from January through December is about 14%. 32 of the 42 years going back to the 1980s were positive. Right now we're down about 10%. So we are, even with the war in Russia, we are still very much in line with a normal year pullback. And we feel like that we just get to be a little bit patient with the markets right now. We're telling people it's uncomfortable, but not unfamiliar. And so it's just kind of how it's working right now. COVID, this slide has been interesting for us. You can see here that confirmed cases, this was the Omicron variant. You can see that cases just jumped from October through basically January, and they've been coming back down steadily. But you can see that the fatalities didn't increase that much. They increased a little bit, but not that much. We feel like that COVID is going to hopefully be a little bit in our rearview mirror going forward, which should open up the markets, should open up supply chains, and should open up a lot of those other types of things. The main thing that I want to show you here is just headlines inflation. So this was based upon January 1st update to economic forecast. They were projecting headline inflation at about 2.7%. Right now, we're actually above 7%. I'm not sure that we will hit that 2.7 by the end of the year, but with oil and gas prices is kind of the dominant force. I've got a couple of slides on oil and gas too that I'll share with you. But they are still projecting that in the next 10 years or so, that inflation still is going to be fairly moderate. Typically, the Fed tries to keep the inflation rate at somewhere around 2 to 2.5%. And they seem to be in that window right now, even with all of the stimulus that has been coming through the government, the additional government debt. And so at least for now, inflation should moderate towards the end of the year, and hopefully by the next year should continue to moderate a little bit as well. This is an interesting slide to me, and this is kind of the upshot from the global technology that we're having right now. You can see job openings since 2019 has spiked dramatically, and you can see that the layoffs from existing jobs have dropped substantially. What that means is that there are more positions open right now than currently people going out and looking. And you can see that quits, people are right now going out and finding additional jobs, but it's just a reshuffling. And so there is right now it seems like there's a great reshuffling in the marketplace, in the corporate economy, of people trying to find better jobs. And the corporations that are best adept at adjusting to the new economy and adjusting to the new technology world are probably going to be those that continue to grow, because they're going to be able to have these people come over and join the workforce. So interesting slide there. Inflation, this is just kind of showing you where things are at. Currently, 50-year average is 3.9. Currently, as of December, 7.1. January 7.5. We anticipate that the first quarter may even be a little bit higher than that with what's going on with the oil prices. All right, and here's our slide on the oil markets. One of the things that I want to show you here is that, again, this was as of March 1st. Prices have actually increased a little bit since March 1st. I think they're up to $107 per barrel right now. So we are a little bit elevated, but you can see here in 2010 through about 2015, oil prices were very similar to what they are right now. So again, even with taking the Russian oil offline, our oil supplies seem to be, again, a little bit uncomfortable, but not unfamiliar is basically what we're looking at. So we anticipate that once things kind of wind down a little bit, we anticipate that things should get a little bit better. We don't know how long that's going to take, but that definitely will be a factor for inflation going forward. The other thing here is that this is the active rigs in the United States. And you can see here that since 2020, active rig count has been increasing. Again, that's because of this increase in prices. One of the things that has happened is there is an oil field, a very large oil field up in North Dakota and South Dakota. And but it is in shale. And from what I've read over the years, that shale is quite a bit harder to extract from the ground. It costs a little bit more to get it out of the ground. And the break-even point before corporations start to become profitable in those fields is about $50 per barrel. Obviously, we're above the $50 per barrel right now, but from the stats with regards to those oil fields, again, we don't know with the Biden administration how much of a wrench he's going to throw into this. But the reality is that those oil fields literally could completely make the U.S. Oil independent for, they say, like 50 years. There's that much oil up there. It just depends upon how much appetite we have for drilling right now. All right, transition for global energy. This is kind of an interesting stat. Fossil fuels has kind of remained the same for the last 6 years, but you can see that alternative sources of fuel is increasing. So our total amount of fuel has increased over the years. This is going to be something that we'll be watching as well. Interesting is that solar right now is less than both nuclear and coal. It's less than natural gas to produce. And about the same cost as wind. So the cost of alternative energies is coming down and capacity is growing. So that's also good news long-term for our economy. The last thing that I just want to hit here real quick is just interest rates. The Fed is projecting 3 interest rate hikes this year. We feel like that they'll probably moderate that a little bit just because of what's going on in the economy and trying not to throw too much water on the economy while we're going through this war and through the spat with Russia. But interest rates will increase. It's something that anyway, we're managing it the best that we can. Anytime that interest rates increase, it always affects bond prices. And for a period of time, interest rates just are not going to be that high, even with these increased in interest rates that are happening through the Fed. So something that we're watching, something that we constantly are looking at of ways that we can help our clients take advantage of this, but it's something that is going to be happening. What you see here and the difference, the reason that this chart's important is because this line is what the Fed is currently projecting. This line is what the market is currently projecting. So the market is projecting that we'll cap out at about 1.87, maybe 1.94. The Fed is projecting that we'll cap out at 2.5. So it's yet to be seen how that'll happen, but we'll see how that goes going forward. The last slide that we have here for this afternoon is just the balance sheet. This is the government's balance sheet. You can see that this is treasuries, mortgage-backed securities, other loans that they've got. And you can see that we have had, since the stimulus in 2020, since COVID hit, you can see that we have had a dramatic increase in the government's balance sheet with spending. Most of that has happened through debt. But the forecasts are is that hopefully this is going to moderate a little bit going forward. Now, our opinion on this is that it's not going to moderate because the government is going to buy back the debt. It's going to moderate because the economy is going to increase. So if the economy doesn't increase, these numbers will look a lot worse going forward. So that's something that we definitely have to keep a watch on and take a look at. So here's our summary for the market. Number one, we feel like that the economy is still in really good shape, despite what's going on in Russia, despite the current market drop, despite where we're at in the S&P 500. We feel like that corporations are in a really, really good spot and should be able to weather this current downturn very well. We are in a bear market right now. We call it a market reset. These happen about every 3 years. We expect them. We actually have been expecting this one for probably the last 5 years. And so it's not unexpected, but the plans that we have set in place for our clients, especially for those that are taking out distributions out of their IRAs and their 401ks, the plan will still work. We feel like that given the situation that we've got for you, we are very optimistic about those plans working. Obviously, we can't give any guarantees, but based upon historical and what we've seen, we feel very comfortable with those plans moving forward. So we're just encouraging everybody to come in, meet with us, make sure that if you have any issues, if you have any concerns, that you make sure that you're giving those to us so that we can help you through them. And with that, we're going to go ahead and close. If anybody wants to post a question, we're happy to answer those for just a minute. But thank you so much for jumping on with us and being part of our presentation. Thank you. Any questions? You can just pop on your little screens and you can, if you, let's see, let's make sure that I've got mine. Okay, I'm not seeing any questions, so we are going to go ahead and wind down with this. Thank you, everybody, for joining in with us. We appreciate it very, very, very much. Thank you again. Bye-bye.